China's secret plan to control global gold prices. For over a decade, one nation has been moving quietly, buying gold in the shadows, building vaults the world barely noticed, opening exchanges that few outside its borders understood, and now the pieces are starting to connect. What if the price of gold, the number flashing on every trading screen in London and New York, is no longer being set where you think it is? What if the West already lost control and simply hasn't realized it yet? By the end of this video, you will understand exactly how this happened and why it may be too late to stop it. Welcome back to Precious Metals Intelligence. If you're new here, this channel exists for one reason: to help serious, thoughtful viewers understand the strategic forces quietly reshaping the global economy, long before those forces become headline news. Today's story is one of the most important we've covered. And before we begin, we'd love to know where in the world you're watching from today. Drop your city or country in the comments below. This audience spans the globe, and it's always remarkable to see just how far these ideas travel. Now, let's begin. For more than 50 years, the price of gold has been decided in two cities, London and New York. Traders in these cities set the number that the whole world follows. Banks, governments, and investors all look to these markets to know what an ounce of gold is worth. For decades, almost no one questioned this system. It simply was the way things worked. The system did not appear by accident. It was built after a major shift in the 1960s and 1970s, when a group of central banks that had once worked together to control the price of gold gave up on that effort. Soon after, a new kind of gold trading began in the United States. Contracts were created that let people buy and sell gold on paper without ever touching the metal itself. This paper trading grew fast. It became larger, in many ways, than the actual physical market for gold. The world grew used to a price shaped mostly by trading desks, not by people holding real bars in their hands. For a long time, this arrangement gave a small number of Western institutions enormous influence. They could see order flow. They understood where big buyers and sellers were positioned. They had, in a very real sense, a view of the market that outsiders did not have. Few people outside the financial world thought about this. Fewer still imagined it could ever change. Then quietly, something began to shift. In the early 2010s, China opened a new gold exchange in Shanghai. At the time, almost no one outside China paid much attention. It seemed like a routine step. Many countries have their own commodity exchanges. There was no dramatic announcement, no bold declaration of intent. To most observers, it looked like a simple piece of financial infrastructure, built for domestic convenience. But it was not simple, and it was not only for convenience. This exchange gave Chinese buyers and sellers a place to trade gold using their own currency, the yuan. It gave the government a tool it did not have before. Slowly, over the years that followed, this tool would be used again and again. Each time, it was framed as a small technical improvement. Each time, the change looked minor on its own. Yet these were not random moves. They were early steps in a much longer plan, one that would take more than a decade to unfold. At first, few analysts connected the dots. Financial commentators were focused on daily price swings or on interest rate decisions from the U.S. Federal Reserve. They were watching short-term events. They were not looking closely at the long, patient build-out happening in the background. But patience is often the most dangerous strategy of all. It does not announce itself. It does not ask for attention. It simply continues, year after year, until one day the world looks up and realizes the landscape has changed. This is what makes China's approach so different from how many people expect major economic shifts to happen. There was no single moment of confrontation, no sudden takeover. Instead, there was a slow, steady accumulation of pieces, an exchange here, a rule change there, a new type of gold contract, allowing trade to happen without needing approval from Western institutions at all. Each piece, taken alone, seemed easy to dismiss. Together, they told a very different story. Historians who study the rise and fall of economic powers often point to this same pattern. Major shifts in global influence rarely happen overnight. They happen through small, careful steps taken over many years, often while the rest of the world is distracted by more immediate events. What looks like a minor policy change in one decade can become the foundation of a completely new system in the next. That is exactly the position gold markets find themselves in today. The system that once seemed unshakable, built firmly in London and New York, now has a serious challenger. Not one that shouted its arrival, not one that fought for headlines, but one that built quietly and steadily for more than 10 years. And as the next part of this story will show, that quiet beginning was only the first move in a much larger and more calculated plan. A single exchange was never going to be enough. Anyone who studies how nations build lasting power knows this. A new marketplace, on its own, means very little if the rest of the world has no reason to use it, trust it, or store anything valuable inside it. China understood this early, and so after the Shanghai Gold Exchange opened its doors, the real work had only just begun. The next stage was not about announcements. It was about concrete, physical things. vaults, storage facilities, systems for clearing trades and settling them in real metal, not just numbers on a screen. Over time, China expanded this physical backbone, adding new storage capacity and, more recently, a vault in Hong Kong connected to a new clearinghouse. To most people, a vault is a boring detail, barely worth a headline. But in the world of gold, vaults are not boring at all. They are the proof behind the promise. They are what separates a market built on trust in paper from a market built on trust in something you can actually touch. This distinction matters more than most people realize. In the West, the vast majority of gold trading happens on paper. Contracts are bought and sold constantly, but very few of them ever end in someone actually receiving physical gold. Most contracts are closed out, rolled over, or settled in cash long before delivery day arrives. Some estimates suggest that fewer than 1 in 10 contracts ever results in real metal changing hands. The rest is simply speculation, layered on top of speculation, moving prices up and down without much gold moving anywhere at all. China's strategy has pushed in the opposite direction. Instead of building a market dominated by speculation, it has worked to build one grounded in physical reality. Buyers in Shanghai are encouraged, and in some cases required, to think in terms of real ownership rather than pure trading. This is not just a cultural preference, it is a deliberate design choice, one aimed at shifting influence away from traders who never touch the metal and toward participants who actually hold it. At the same time, another force has been working alongside this infrastructure. China's central bank has been steadily buying gold year after year, adding it to national reserves. This is not the kind of buying that grabs attention with a single dramatic headline. It is slow, it is disciplined, it happens quietly month after month, often without much public comment. But its effect adds up. Every ounce purchased by a central bank is an ounce removed from the open market, an ounce that will not easily be sold off during a period of panic or short-term weakness. This steady demand plays an important supporting role. It creates what analysts sometimes call a floor beneath the price. Even when speculative traders in the West sell aggressively, pushing prices down sharply in a short period, this central bank buying provides a kind of quiet resistance. It does not stop prices from moving, but it changes the deeper structure underneath those movements, making the market less fragile than it might otherwise be. Put together, these two forces, physical infrastructure and steady central bank accumulation, represent something larger than the sum of their parts. They represent an attempt to change what kind of market gold actually is, not a market ruled by fast trading desks in New York and London, reacting to headlines within seconds, but a market increasingly shaped by physical ownership, patient accumulation, and long-term strategic thinking. This is often described using a simple phrase, the difference between being a price maker and a price taker. For decades, China, like most of the world, was a price taker. It accepted whatever number Western markets produced and adjusted its own buying and selling around that number. The infrastructure built over the past decade was designed to change that role entirely, not by rejecting the global gold market, but by building enough physical weight and enough independent infrastructure to eventually influence how prices are formed in the first place. None of this happened quickly. None of it happened through force. It happened through years of construction, accumulation, and patience, while the rest of the world remained focused on more immediate financial news. But infrastructure and reserves were still only part of the picture. To truly change the balance of power in gold markets, something else was needed. A way to connect this new physical foundation to the currency itself and to the flow of trade around the world. That connection is where the story turns next. Gold alone was never the entire objective. A country can hold vast reserves of gold, build impressive vaults, and still remain dependent on someone else's currency for trade. This is a lesson history has taught many nations, sometimes painfully. Real influence in the global economy does not come from metal sitting in storage. It comes from the currency that metal supports, and from how willing the rest of the world is to use that currency for everyday business. This is where China's strategy took its next important turn. The Shanghai Gold Exchange was not built simply as a place to trade metal. It was also built as a bridge between gold and the yuan, China's national currency. Within this exchange, a buyer can exchange yuan directly for gold. This may sound like a small technical detail, but its implications run much deeper. It means that gold, one of the most trusted assets in the world, can now be accessed through a currency that, until recently, played only a minor role in global trade. For decades, the US dollar has served as the main currency for international transactions. Oil, grain, machinery, and countless other goods have typically been priced and paid for in dollars, no matter which two countries were actually involved in the trade. This arrangement gave the dollar enormous influence. It also gave the United States a level of economic power that few other nations could match. Every country that wanted to trade internationally needed dollars, and that need reinforced the dollar's position again and again. China's approach chips away at this arrangement, not by attacking the dollar directly, but by offering an alternative path. A trading partner uncertain about relying too heavily on dollars now has another option. It can settle certain transactions in yuan, and if needed, that yuan can be connected to gold through the Shanghai system. This does not replace the dollar overnight, but it does create a growing crack in what was once a nearly unquestioned system. Alongside this currency strategy, China has also taken clear steps to bring more discipline and stability to its domestic gold trading. Earlier this year, retail traders across the country were required to close out certain futures positions, tightening the rules around speculative trading. On its own, this looked like a routine regulatory update, the kind of adjustment financial authorities make from time to time. Viewed alongside everything else, it fits a much larger pattern. This pattern is about legitimacy. A market filled with excessive speculation, where trading resembles a casino more than a genuine exchange of real goods, struggles to earn deep, lasting trust. By reducing leverage and encouraging more responsible trading behavior, China has worked to build a market that looks less like a gamble and more like a serious, dependable system, one capable of eventually attracting the kind of long-term global participation that lasting influence requires. Each of these steps, taken individually, could easily be dismissed as routine financial housekeeping. New trading rules, currency access, adjustments to margin requirements. None of them, on their own, sound like the beginning of a major shift in global economic power. This is precisely what makes the strategy so effective. It does not rely on force or sudden confrontation. It relies on accumulation, on one careful step following another, until the changes become too significant to ignore. Slowly, the influence long held by Western trading desks over gold price discovery has begun to erode. Not because those institutions have lost their skill or their resources, but because an alternative system has been quietly built beside them, offering another path for anyone seeking access to gold that does not run exclusively through London or New York. For years, this shift remained mostly invisible to those outside specialized financial circles. It did not produce dramatic headlines. It did not spark heated debate on major news networks. It simply continued patiently in the background, while the rest of the world's attention stayed fixed on more immediate, more visible events. Yet patience of this kind carries its own quiet power. Systems built slowly, brick by brick, tend to be more durable than those built quickly in response to a single crisis. What China has constructed over the past decade is not fragile. It is not dependent on any single event or announcement. It is a foundation built deliberately, designed to support a much larger transition. And as global events accelerated in recent months, that foundation would soon be tested in ways few observers expected. The next part of this story turns to those events and to how a period of crisis became the moment this long-term strategy truly began to show its full effect. Every long-term strategy eventually meets a moment of testing. For years, China's approach to gold had unfolded slowly, almost invisibly, through vaults, exchanges, and quiet policy changes. Then, within the span of a single year, a series of dramatic events pushed this quiet strategy into the open, revealing just how much the underlying structure of the gold market had already shifted. The first shock came from geopolitics. A major conflict erupted, and within days, financial markets that had seemed calm just weeks earlier were thrown into turmoil. Interest rate expectations shifted sharply. Investors began pricing in higher borrowing costs and a stronger US dollar as fear pushed money toward traditional safe havens in the short term. Gold, counterintuitively, fell. It dropped hundreds of dollars from its highs, confusing many casual observers who assumed war and uncertainty should always send gold prices higher. But beneath this surface-level drop, something else was happening. This was not simply panic selling. It was a market wrestling with two competing forces at once. On one side, fear of war and inflation, historically supportive of gold. On the other, fear of higher interest rates, which tends to pull investors away from gold and toward interest-bearing assets. For months, the second force appeared to win. Then came a moment that many analysts now view as a turning point. Currency authorities in the United States took an unusual and aggressive step, intervening directly to support the Japanese yen, which had been weakening rapidly. This intervention was significant, not just because of what it did, but because of what it revealed. It showed the world that Western financial authorities were willing to take extraordinary, unprecedented action to protect the stability of the existing system, even when that action carried real risk and real cost. Some analysts drew a comparison to an earlier moment of reckoning, one that took place several years earlier, when a major nation's foreign currency reserves were suddenly frozen during an international conflict. That event had already pushed many central banks around the world to quietly reconsider how much they should rely on holding another country's currency as their primary reserve asset. This new intervention reinforced that same lesson. It reminded central banks everywhere that reserves held in someone else's system can be restricted, controlled, or frozen if political circumstances change. Gold, unlike currency held in a foreign bank, cannot be frozen with a single decision. It cannot be restricted by another nation's policy choice. This simple fact, long understood in theory, suddenly felt far more urgent in practice. It was in this exact environment that China's gold buying accelerated. In July alone, official purchases reached 20 metric tons, far above the pace maintained in prior years, when annual purchases had often totaled less than 30 tons for the entire year. This was not a coincidence. It was a deliberate response to a moment of weakness in price, combined with a growing sense that the old system carried risks many nations could no longer ignore. This is the essential pattern behind a fracture point. It is not a single dramatic collapse. It is a moment when accumulated pressure, built up slowly over years, suddenly becomes visible to everyone at once. The infrastructure China had built, the vaults, the exchanges, the currency connections, had been waiting for exactly this kind of moment. When trust in the old system wavered, even briefly, the alternative system was already prepared to absorb the shift. Meanwhile, confidence in gold itself, as an asset independent of any single government's control, only grew stronger. Central banks that had spent years quietly accumulating gold found themselves holding an asset that behaved exactly as intended during a moment of genuine crisis. It did not need permission from another country. It did not depend on trust in any single financial institution. What began as a quiet, decade-long construction project had now met its first true test under pressure. And the results of that test would shape the next chapter of this story, one that reaches directly into the question every serious investor and decision maker now needs to consider: what happens next once the balance of power in gold has already begun to shift.